The contribution format income statement for Williamson Incorporated for last year is given in the table you see on the screen now. The company has average operating assets of $2,865,000 during the year. And on this problem, here's what we're asked to solve. Requirement 1. Compute the company's return on investment, that's ROI, for the period using the ROI formula stated in terms of margin and turnover. Okay, now to solve requirement 1, where we're going to compute ROI using margin and turnover, I've shrunk the information given so that we have a chance to see how we solve this as well. Alright, ROI is calculated by taking margin times turnover, and margin is equal to net operating income divided by sales. Turnover is equal to sales divided by average operating assets. So using the information that's provided, we take the $388,000 of net operating income and we divide it by $4,075,000 of sales. That will give us a margin of 9.52%. Then we multiply it by turnover, and we get turnover by taking sales of $4,075,000 and dividing it by average operating asset, which is given in the last sentence of the information, of $2,865,000. That gives us turnover of 1.42, and when we multiply the 9.52% margin by the 1.42 turnover, we calculate ROI of 13.52%. Now, for requirement 2 and all the other requirements, we are to indicate whether the margin and turnover will increase, decrease, or remain unchanged as a result of the events described, and then compute the new ROI figure. We're to consider each question separately, starting in each case from the data used to compute the original ROI in one above, and that's the information that you have on the top part of the screen. Requirement 2 asks us to use just in time. The company is able to reduce the average level of inventory by $472,000. And the released funds are used to pay off short-term creditors. So with that information, we need to determine whether margin and turnover will increase or decrease or remain unchanged. Okay, well, given that we're able to reduce inventory by $472,000, what we see is that there is no change in terms of the margin. So there's no income statement impact. But in terms of turnover, given that we have the same sales and then a lower investment in average operating assets, we see that the turnover increases by 1.7. So as a result of multiplying an unchanged margin by an increased turnover, ROI increases to 16.18%. Next, we take a look at what happens when the company achieves a cost savings of $52,000 per year by using less costly materials. Well, the cost savings results in a $52,000 increase to net income. So what we see is an increase in margin from where we were in the base case divided by sales. So as a result, margin increases. And in terms of the balance sheet side, or the turnover, meaning sales divided by the investment assets, there's no change there. So here again we have an increase times an unchanged turnover amount, and that also increases ROI, and in this case to 15.34%. Now on requirement 4, they tell us that the company issued bonds and used the proceeds to purchase $50,000 in machinery and equipment at the beginning of the period. They tell us interest on the bonds is $11,500 per year and sales remained unchanged. The new, more efficient equipment reduces production cost by $38,000 per year. Okay, well, when we look at ROI on this, The savings in the production cost drives up the margin, right? We're going to have higher operating income as a percentage of sales. So we get an increase from the margin portion of the ROI calculation. In terms of turnover, though, we get a decrease because we invested $50,000 more in machinery and equipment, so average operating assets increased. Now, keep in mind that the interest cost is a financing expense, and it's not used to compute net operating income. But in this case, the increase in the margin offsets the decrease in the turnover when we multiply them together, and as a result, ROI increases to 14.63%. Requirement 5 says, as a result of more intense effort by salespeople, sales are increased by 30% and operating assets remained unchanged. Okay, well in this situation, margin would increase. Turnover would also increase, resulting in ROI of 26.84%. Let's take a look at the details involved in calculating that increase in ROI. Alright, sales would increase by 1.3 times to $5,297,500. The variable expenses would increase as well. But as a result of sales increasing variable expenses, contribution margin increases to $1,649,007. Requirement 6 says, at the beginning of the period, obsolete inventory carried on the books at a cost of $60,000 is scrapped and written off as a loss. Okay, on this one, we see that margin will decrease as a result of the write-off, which impacts net operating income. Turnover increases, though, because average operating assets are reduced. And as a result, we multiply a decrease times an increase. In this case, the margin more than offsets the increase in turnover, and as a result, ROI decreases to 11.67%. Requirement 7 says, at the beginning of the period, the company uses $32,000 of cash received on accounts receivable to repurchase and retire some of its common stock. As a result of this transaction, margin remains unchanged. There's no impact on the income statement. But turnover results in an increase. And the reason why we see that is because the average operating assets will be reduced by the reduction of the accounts receivable. And as a result, the net effect is an increase in ROI when we multiply the margin times the turnover, and the new ROI becomes 13.71%.